Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our free Forex trading course with a look at the major factors which affect the Swiss franc. In today's lesson we're going to begin a new discussion on the world's main commodity currencies, starting with a look at the Canadian dollar. So let's get started.
There are two dominant themes that is important to understand when analyzing the Canadian dollar from a fundamental standpoint. The first, as its designation as a commodity currency implies, is the fact that exports of natural resources, especially gold and oil, make up a significant part of the Canadian economy. This is important to understand because as Canada is the world's 14th largest producer of oil and 5th largest producer of gold, the price of these and other commodities normally has a direct effect on the Canadian dollar's exchange rate. The second thing that is important to understand here is the fact that as the Canadian population is relatively small in comparison to its landmass, the economy is heavily reliant on exports, which ties the country more closely together with the international economy. This is particularly true in regards to the economy of the United States, as the U.S. is Canada's largest trading partner, and 81% of Canadian exports flow to the U.S. While many people believe that the U.S. relies most heavily on the Middle East for its oil imports, it is actually Canada that is the largest supplier of oil to the United States. As the U.S. is the world's largest oil consumer, and Canada is one of the world's largest producers, fluctuations in the price of oil have double the impact on the US dollar-Canadian dollar exchange rate. As we learned in our lesson on trade flows, as the US is a net oil importer and Canada is a net oil exporter, then all else being equal, a rise in the price of oil should strengthen the Canadian dollar and weaken the US dollar. While exports of commodities are still a very important component of the Canadian economy, the country's service sector has experienced massive growth in recent decades. This has been to the point where the service industry now accounts for 2/3 of the country's economic output. This is important to understand because as the United States is its largest trading partner, a slowdown in the U.S. economy can hurt the Canadian economy and its currency, even if commodity prices remain high. As with the other currencies we've looked at, in the interest of maximizing our learning, I'm going to defer to fxwords.com for an overview of the country's primary economic indicators. I've included a link to the Canadian Economic Indicators page on FXWords below this video on InformedTrades.com, which provides a detailed overview of each, as well as their relative importance to the market. For a snapshot of when each of these indicators is released, as well as what analysts' forecasts for the release are, I encourage you to use the global calendar, which you can find at the top of dailyfx.com. That's our lesson for today. In our next lesson, we will continue our discussion of the commodity currencies with a look at the Australian dollar, so I hope to see you in that lesson. As always, if you have any questions or comments, please feel free to post them in the comments section below, and good luck with your trading.